Across the global financial system, the board is resetting, triggering a process that pulls wealth from the edges into a single centralized fortress. This is the New York Stock Exchange. It represents a $60 trillion market, the most significant engine for wealth generation in the world. While foreign entities own 30% of these assets, that participation is largely restricted to sovereign wealth funds and massive pension groups. For the average retail investor in Asia or Africa, this market remains effectively out of reach. Rigid capital controls and the high barrier to international brokerage accounts keep the global working class on the outside. As local currencies in these regions lose value to inflation, citizens are left watching American markets grow from a distance. The current structure ensures the global majority is locked out of the most stable wealth generator. This structural barrier is starting to dissolve. A Bloomberg report highlights a major shift within the U.S. Securities and Exchange Commission. The agency is exploring an innovation exemption that would allow the U.S. stock market to move on to decentralized crypto exchanges. This diagram shows a corporate stock certificate becoming a digital token. These tokenized stocks are exact digital replicas of shares in companies like Apple or Tesla, existing entirely on a blockchain. By hosting these assets on decentralized exchanges, the system removes traditional brokers. Access becomes borderless and immediate. The gatekeepers are bypassed. Anyone with a smartphone and an internet connection can buy into the American economy. By dismantling its own financial borders, the U.S. changes how capital is deployed across the globe. Participating in this market requires digital dollars, specifically stablecoins like USDT and USDC. Trading stocks with stablecoins is often presented as a solution for global financial equity. Figures like Changpeng Zhao argue that this setup provides the unbanked masses with essential access to the world's best-performing assets. The process is simple. A citizen in a developing nation converts their local cash into stablecoins using a mobile app. Those stablecoins are then immediately used on a decentralized exchange to buy tokenized shares of U.S. tech giants. This creates a direct funnel, redirecting retail savings from around the world into the American economy. As local currencies rapidly lose their value, everyday citizens begin dumping their hard-earned cash in favor of this digital alternative. When millions of people sell their local money to acquire stablecoins, the impact on the domestic economy is immediate. Local liquidity dries up, causing the value of these currencies to drop further. This chart shows the direct correlation. As local currency values plummet, stablecoin volume rockets upward. By moving their savings into tokenized assets, these individuals migrate their entire financial existence into the U.S. ecosystem. This process effectively extracts liquidity from rival economies, using foreign inflation as a vacuum. This system relies on a specific backing mechanism. Every legitimate stablecoin is backed one-to-one by U.S. dollars. The primary asset used for this backing is U.S. Treasuries, the debt issued by the American government. This flowchart illustrates the chain reaction. Global demand for stablecoins forces issuers to buy massive amounts of U.S. Treasuries to maintain their reserves. As global demand for Treasuries increases, the interest rates the U.S. government pays on its debt go down. This allows the American government to refinance its national debt at significantly lower rates. This dynamic provides a continuous source of funding for U.S. spending, subsidized by retail investors worldwide. This system secures a digital dollar empire, ensuring global wealth remains permanently tied to American infrastructure.